Hi, this is James Ng, and today we're going to be talking about investment philosophy. And I saw this quote a long time ago. It said, quote, every decision in life should move you from a laborer to a capitalist. And once I read that quote, it made a lot of sense in terms of, at first, when you're first starting out, you're going to have to trade sort of time for money. But at some point, your money should be able to generate income for you. And this quote from Howard Marks: most investors' results will be determined by how many losers they have and how bad they are, than by the greatness of their winners. So let's jump in. I'm going to talk about two things really today. Number one, building your investment philosophy, and then my investment philosophy currently in today's market. So my background, I was an underwriter for GE Capital for 8 years. And then the last 5 years, I've been a mortgage broker focused on originating multifamily debt and then also investing in close to 25, 26 properties across DFW, Austin, and San Antonio as a passive investor. So let's talk about building your investment philosophy. And I started with, 6 questions. Number one, why you're doing this, when, what, where, how, and who. So let's start with why. So why are you building? Why are you investing? Right. So is it cash flow? Is it capital gains? Is it to replace your W-2 income? Or is it to build a business? Like if you're a general partner and you're trying to build this into a business. Number two is when. So a lot of times people are just getting started, right? So there's going to be personal timing, whether you have the liquidity to do this, right? So most deals are going to take anywhere from 50, 75, $100,000, and you have to have the liquidity to do this, right? This is not like a 401k. This is not like one of those things where you can just come in and put in $100 or $500 a month. You have to actually have the chunk of money ready to go, and you can't touch the money for 3 to 5 years. Or, is it cycle timing, right? So you see an opportunity right now, market's down, it's time to move forward and start investing. So when is the second? Um, and number three is, so what are you going to invest in, right? What property type? So whether it's single family, multifamily, office, retail, hotels, etc. And then within that, is it going to be class A, B, C? And then, is it going to be development or stabilized or heavy value add? Number four is where, right? So if you're here in Texas and you want to invest in Texas and be local, or you live in California, you live in New York and you want to invest in Texas, or you want to invest in Florida, or you want to invest in sort of the Southeast, like where are you going to actually invest? And then the decision of primary, secondary, or tertiary. So whether you stay in, the major metros like DFW, Austin, Houston, San Antonio, or go out to your secondary markets where you might have less competition, a little bit higher cap rate, but then, maybe you don't have as many qualified managers. Maybe you don't have as much liquidity during a downturn. So you have to balance those two things out. Number five is how, right? So do you have the money to do this on your own and be an independent owner? Or are you going to be a general partner and raise money from other people and partner with other people and take on limited partners? Or are you just going to be a limited partner? You're going to be passive. You have a high paying job, whether it's a doctor, attorney, engineer, and you just want to continue doing that. And then instead of investing in the stock market, invest passively. And then last is number six is who, right? So who are you going to really build your team and do this with, right? So independent owners, you really need listing brokers and property managers. General partners, you need other general partners to sign with you. You need passives. And LPs, all you really need is general partners, right? So if you have general partners, you can invest with them. And then as you start looking to build your team, who are you going to work with, right? Who are you going to invest your dollars with? So looking at track record, their management style, their communication style, how much are they investing in the deal? Are they local to it? And then how much liquidity do they have for downturns like we're facing right now? And so here's my investment philosophy. And I sort of took it category by category. So why am I investing? I'm investing for passive cash flow. Um, there's a lot of people who could invest for capital gains. My goal in investing in multifamily has, number one, been cash flow. Number two, when. So here's a couple nuanced ways I've been looking at it right now in terms of personal liquidity, that I've sort of grown up through Dave Ramsey, Robert Kiyosaki, and sort of gone through those steps. And so now I'm looking more macro. sort of not necessarily personally when I need to invest, but then also macro, how the economy is looking. So the two things that I pulled out were 2 consecutive quarters of positive GDP growth, because I saw that there was sort of into the bear market, entering a bull market. So you'll be towards the trough of the cycle. And then I didn't want a yield curve inversion. So that's where like your short-term maturities are less than your longer term maturities. So I'll show you a chart later comparing 3-month maturities and 10-year treasury maturities. And then returns right now, I'm looking cash flow of about 8% on an amortizing basis by year 2, and then 15 plus IRR over 5 years. So that's what I'm looking for right now. Number 3 is what am I going to invest in, right? So I like stabilized primary markets, consistent collections, conventional class B with 150 units or higher, no student, no senior, no employer concentrations, and then no development. And I want whoever's doing the loan, I want typically 5 years or longer. I don't want anything short term like a 3-year, just in case this recession drags out longer. 5-year loan or longer, preferably probably 7 to 10. No deals along the coast where there's hurricanes or in a floodplain. In terms of ground floor retail, no ground floor retail. And then I want to see the price of the asset below its intrinsic value. So let's say class B in Dallas right now, earlier this year it was probably 125 to 150 a door. I want to see that come back down, whether it's a 10, 15, 20% discount, maybe down to closer to 100 a door or 85 a door. Because I think replacement cost is a lot more than that. So below its intrinsic value. In terms of number 4, where primary markets in Texas, right? So I grew up in Houston, have lived in Dallas now since 2006, and then also went to school in Austin. And so I think the major markets in Texas where I'm going to focus, how it's going to be passive as a limited partner. And then 6, who. So as a limited partner, I'd be looking at general partners, right? So I want these people to have a track record of at least 5 deals. Asset management is strong, either in-house or third-party property management. And I want them invested in the deal. I want them to live in the market they're investing in. And then also, I want them to have liquidity. So I want them to have the liquidity that if we do run into a hiccup, a downturn, they have the money to front instead of coming to all the limited partners for cash flow. So let's dig into a couple of these points. In terms of cycle timing, here's a chart that shows in the grays all the recessions and in the GDP quarter over quarter. And you can see that, like preceding every downturn essentially had maybe 2 to 3 quarters of negative GDP. And then it comes out and has a positive quarter. And as these positive quarters sort of grow consecutively, it just gives you more and more confidence in the economy. And sometimes there's negative quarters of GDP, but typically it's just one. So to have 2 quarters of negative GDP really shows the sign of entering a bear market. And then, 2 quarters of positive, and there's a bull market. So as you can see at the very edge of this chart, you can see that Q1 was like negative 4.6, I think. A GDP, Q2 is going to be a negative. It'll probably be off the chart. It'll probably be negative 20. And so Q3, Q4, that's where we'll really start seeing potentially 2 quarters of positive GDP growth. No yield curve inversion in the previous 18 months. And so you can see, early 90s, early 2000s, 2006, 2007, every time there was a yield curve inversion, there was a recession. And so showing the yield curve inversion, it's almost like a waiting game. So once the yield curve inverts, then there's going to be a recession. So whether it's coronavirus or something else, that impacts, investment. And so it's more of a warning sign. And so if we had not seen the downturn come with coronavirus, there's probably only been 6 to 9 months since the yield curve inversion. You probably won't be able to see when it's going to come. So that's why I want to give at least 18 months. Since we've already seen the coronavirus hit, we've already seen the downturn. I might pull this in a little bit, but just as a general rule of thumb, I think 18 months is a good time frame. And here I wanted to show just sort of cycles. And I've used this chart before about DFW multifamily. You can see The run up, B's essentially from 2008 to 2012 were pretty much flat at around 80 a door, in that upper mid range. And, they made a run all the way up to about 140, 150 a door. And I think on this lower right hand chart, you can really see, I think we're still sort of in that downward slide between fear and panic. And I don't think we've hit that point of sort of maximum opportunity. And you don't really know when that point's going to be. But I think once you start seeing some positive light on the GDP side, then, we'll start getting back into a bull market. And in terms of property type, I mean, I just listed the items here a little bit larger. Stabilized deal, as an LP, I want stabilized collections, class B or higher, 150 units, just really utilizing the economies of scale. I don't really want any big shocks to the property, right? So something like senior housing where, let's say a deal, this COVID hits and there's a lot of people, it's taking a long time to get, seniors back into housing, or employer, let's say an auto plant goes out of business, or, oil, there's a large industry concentration in oil, and, all of a sudden you can't lease up your building. So, and in students a whole different animal than conventional. Just the number of the cycle, the timing of the leasing, everything's a little bit harder on the student side. And, with all this e-learning, I mean, I don't know if universities are still going to have the same demand as forecasted on the student side. And then new construction lease up, it's very hard to invest in those deals when you're investing for cash flow. And so development typically takes, 2 to 3 years with no cash flow. Then you got to lease up and then hopefully sell on the back end. So that's why I haven't done any development deals. And then no deals on the coast. I've seen too many deals that have just, been hit very hard, whether they had flood insurance or not. And, it can take out the whole first floor of a building and pretty much, cost you cash flow for 2 or 3 years. And by the time you repair it, you might get flooded again. I mean, a lot of people that I know in Houston have been flooded 2 or 3 times already. And in ground floor retail, like retail's changing, significantly. And then even ground floor retail on multifamily is even hit even more, I think, just because, that they usually don't make any money on that rent. And so I think Fannie and Freddie are even, they're not giving any credit to those tenants. And then, cash flow, I think, previous, when I started investing in 2015, you could probably get this 8 to 10% by year two. And then we've just seen that dwindle away in the last couple of years. And it's, you were happy to get 8% on an IO basis. So I think for that to reset, and then target returns to reset will give you at least a level of comfort that you're buying at a discount to get these higher returns. And then when you're thinking about A, B, and C, I think I like this chart the most just because it shows that the C class really in the last recession rose to 12% vacancy. And that was physical vacancy. I mean, it's down to closer to 5%, but it just shows the volatility in that class versus maybe like your A or B deal. It's really in that 6 to 8% vacancy, maybe 9% vacancy. And it's just more steady. And then general partner. So, I mean, I want to see a longer track record, 5 deals at least. And, showing that, they have good in-house property management, they got cash in the deal, and they have liquidity to support it. And then I just want to wrap up sort of with this chart and, investing, Howard Marks says investing is all about dealing with the future. And this chart on the right, it talks about how, like, I think if you do, let's say a Fannie or Freddie loan and, your return is expected anywhere from, let's say 15%, 10 to 15% IRR, you're in this, bottom left-hand part of the chart, right? Like your return, worst case is maybe a 5% return versus a, 15% return. But then as you go further out on the risk curve, let's say you do a heavy value add, you do a bridge loan, 3-year term, you might hit like a 25% IRR or 30% IRR, but you also might lose all your principal if you don't get the timing right, if you don't execute the business plan and you get foreclosed on. So, as a limited partners who's investing for cash flow, my job is not to be that far out in the risk curve. If you're a general partner and that's the business plan and that's what your investors are signing up for and they want capital gains, then by all means go out further on the risk curve. And this is actually not Howard Marks, it's Tim Ferriss, but Tim Ferriss said every investment you make should improve the quality of your life. And so when I think about investments, that's what I always think about is, um, making this investment of 50, 75, 100,000, does it improve the quality of my life or does it make it worse, right? If I'm buying a deal that's 3 hours away from my house and I'm the manager, does that make my life any better in terms of quality of time and quality of investment? Probably not. So Tim Ferriss said that on one of his podcasts, and I really like that quote. So if you like this, subscribe to the YouTube channel, like the video. Really appreciate it. If you want to talk about your next multifamily deal, whether buying, selling, refinancing, give me a call, shoot me an email. And to see all my loan closings, you can go to txmultifamily.com. Thanks a lot, guys.